Okay, good evening, everyone. I think first of all, my name is Jerry. I'm the portfolio manager with FSMOne. And first, before I start, we'd like to thank everyone for staying with us throughout the whole day event. I guess it always been very tough to be the last speaker for the event, and I know probably many of you are already overloaded with tons of information throughout the whole day events. So for my session today, I will try to keep everything short and sweet and straight to the point that I want to highlight to share with all of our investors today. So let me move on to today's agenda. These are the three key things that today I'm going to share with every one of you. First of all, we'll just do a quick recap of the global financial market performance, followed by a review of the FSMOne managed portfolio, and last but not least, which is the most important part, how do we see the markets for the year of 2022, our investment outlook, as well as some of the portfolio strategy, how do we position our investor portfolio for the upcoming years. So without much further ado, let me start off with the first part of my presentation today, a quick recap of the global financial markets performance for the year of 2021. So if you look at the chart here that I put up, clearly you can see three lines, and you see a clear divergence between the blue colors and also the yellow and green color lines. So the blue color lines actually represent the MSCI ACWI, which is the global equity markets performance. And subsequently, if you look at the yellow and also the green color line, which is MSCI Asia ex-Japan Equity Index, as well as MSCI Emerging Market Index, Emerging Market Equity Index. So what we can see here is that clearly we see a divergence, we see a contrasted performance between the developed market, which driven the performance for the global equity market. We see a strong performance from US equity markets and also European equity market for the year of 2021. But oppositely, if you take a step back and look at Asia and Japan equity and also emerging market, the performance is rather disappointed in the year of 2021. And let's discuss a little bit about the factors that contributed to the poor performance of some of these regions. First of all, if you think about it, if you're still able to recall in early 2021, the vaccination progress is actually way faster in most of the developed market like US and Europe. I think if you take a look on most of the emerging market and also Asia and Japan markets, this country, we started our vaccination program quite late, somehow in the late of second quarters or early of third quarters. So that's why, in the first and second quarters of 2021, the overall economic recovery has been hit by another wave of COVID-19. And subsequently, if you also take a look on the way those governments that handle all this pandemic is actually quite different in the Western country compared to most of the Asian country. They are more lenient, they are more, if you look at in some of these Western country, they don't really see it as a key risk to the economy when it comes to the COVID-19. That's why if you look at it, over in Europe and also in most of the US country, we don't see a total lockdown after the first lockdown in 2020. But whereas if you look at most of the Asian country, we also see on and off regularly, we still see a lot of some lockdown in certain places in most of the Asian country. So that's why it's actually affected the overall economic recovery in Asian and emerging markets, which affected the overall equity performance for most of the Asian and also emerging market equity. And the other key factors that has affected the overall investment sentiment in most of the Asian equity market is the regulatory crackdown in China. I think if you're still able to recall somewhere in March and April, Alibaba, company like Alibaba, Tencent, and Meituan, they've been investigated and been fined by the Chinese government. And somewhere in late last year, Didi.com, which just listed in NYSE, they also mentioned that they plan to delist from NYSE and back to Hong Kong. So these are some of the regulatory crackdown that happened in China, which affected the overall investment sentiment, which affected a lot of the tech giants in China. If you look at share price like Tencent, Alibaba, it dropped to a certain extent, it dropped 60 to 70%. So those are the key factors that has affected most of the investment sentiment, particularly in China itself. So if we take a look on the performance for the global equity market, so we can see clearly, like I mentioned just now, there's a clear divergence between the developed market and also the Asian and emerging market. But moving into 2022, we have a different view. We do think that this year itself, it could be a year for Asian equity, particularly for China and also China tech companies. We see a chance of a strong rebound within this market, which I'm going to share with you later on. Next, if we take a look on the bond market performance, so beside equity market, we also take a look on the bond market performance. I believe a lot of our investors, especially for most of our investors who have invested or who have investment experience in the local bond market, Malaysia bond, you have enjoyed a very decent returns by investing into the local bond market over the past couple of years since 2017, 2018, 2019, or even 2020. We have been enjoying a mid to high single digit return by investing into the local bond fund. But somehow in 2021, it wasn't a very good year for the bond market. No matter it's Asian bond, Malaysia bond, global bond, or even the Asian high yield space. I think Asian high yield was a segment that been badly hit by the slowdown in the property sector in China, as well as the Evergrande case. But if you take a look on this global bond market, or even particularly in Malaysia, the Malaysia bond market, what has actually caused a drawdown or correction in the local bond market? I think the key factors is because of the expectation of the monetary policy moving forward. We're actually seeing expectation of a higher inflation rates, not just in Malaysia but globally, because of the supply chain disruption of a higher commodity prices. This has also translated into a higher inflation, and subsequently, market participants, investors also start to think that, probably the central bank in most of the country, they will start to plan to tighten their monetary policy. And that's exactly the factors that contributed to the drawdown in the bond markets, particularly for Malaysia. We also see, investors start to price in, probably there will be one rate hike for Bank Negara going to increase the interest rate by the end of this year itself. So I think a lot of the expectation is sort of pricing, saying that, moving forward, like it or not, people towards the end of 2021, right, people are still wondering that will there be a rate hike in the year of 2022? But at this point in time, it's no longer a question of whether or not there will be a rate hike. It's more like when will be the first hike happen, especially in US. Initially, we are seeing that expectation is that probably there will be one hike by the end of 2022. But right now, I mean, if you look at the market's expectation, the first hike is likely to happen as soon as by the end of first quarter of this year. So these are the factors that has overall affect the global bond market, particularly the local bond market. Then probably the next question that investor will ask is that, should I continue to put my money in bond market? I think this is really a question that we need to further discuss on the later part, which is on the last part of my presentation, to share with you on the overall outlook for the bond and also for the equity market, and how do we actually position our portfolio on a rising interest rate environment. How should we actually position our portfolio between the two asset class, between the equity and also fixed income? Next, I'm going to do just a quick review, a portfolio review for our portfolio for the year of 2021. So what we can see here, overall, this is the overall performance for our balanced portfolio and also aggressive portfolio performance throughout the year of 2021. And later on, I will actually share with you the absolute performance figure. But just to take this chart to explain a little bit on some of the portfolio changes, some of the portfolio action that we have taken for our investor over the year. If we start off with towards the left hand side, in January last year, 2021, early January, we have actually made a decision to reduce our China exposure and also reduce our overall technology exposure for our portfolio, because we have been seeing the valuation for China equity and also the valuation for the global tech as a whole has come to a very stretched level, and we think that it could be a right time for us to take some profit off the book. So we have actually reduced our exposure from China. We have reduced our exposure from technology for the conventional portfolio. Subsequently, we reallocate the capital back into the European equity and back into emerging market equity. So if you think from that perspective, our action to allocate capital from China and technology to European, it seems to be a good move, because last year was really a good year for the European equity as a whole. But the decision to allocate into emerging market has somehow contributed negatively to the overall portfolio performance. And in February, we have also made a decision to replace our global funds for our Islamic portfolio. And we have also added a new technology exposure for our Islamic portfolio, because back before February last year, we don't have any specific technology exposure for our Islamic portfolio. The key reason is because we don't have such a fund within the Sharia compliance space. So that's why after onboarding a new Sharia compliance technology fund, we actually make the decision to add this technology exposure into our Islamic portfolio. And in May, we have actually reduced our Japanese equity exposure, and also we increased back our overall technology exposure for the portfolio in the month of May. Subsequently, in July, we have made some changes to replace the Malaysia equity funds and also our China equity funds. Subsequently, we also added an Asian technology fund. It's also a new fund that we have just onboarded into our platform, but we see opportunity within the Asian tech space. We think that the valuation have come to a very attractive level, but unfortunately, the weak sentiment continues to prolong for the whole year of 2021. That's actually that decision to add this Asia technology fund to the portfolio has actually contributed negatively to the overall performance of the portfolio. And another decision that we have made in the month of July is actually to switch most of our MIR hedge position for our equity exposure to the non-hedge exposure, because we actually see the limited upside potential for ringgit, and we see a potential of depreciation from the ringgit perspective. So we actually started to move our exposure from ringgit hedge to non-hedge class. Yeah, and in September, we have made some changes to both our conventional and also our Islamic portfolio. For the conventional portfolio, we have replaced our Asian technology fund with the specific China technology fund, which is the Hong Kong Tech Index Fund. It's a fund that fit into the Hang Seng Tech Index, which is a fund that provides us with a pure China technology exposure. So subsequently, in the month of September, we also think that it could be a time for us to increase more of our equity exposure, because we also think that at that point in time, we do think that the inflation rate will start to stay at a high level, and monetary policy tightening is really a matter of time. And in such an environment, we do think that there is a better chance for equity market to outperform the fixed income market. So we make a call to increase our overweight equity from 2.5% to 5%. And for our Islamic portfolio, we have also replaced our ASEAN fund. Previously was the Maybank Greater China ASEAN Fund. We replaced that fund, and we also added a China A exposure for our Islamic portfolio. Back in December last year, which is the last action that we have taken for our conventional portfolio, we increased our overweight position in Asian high yield. Back then, we only have about 10% of our fixed income exposure in Asian high yield space. We make the call to increase the exposure from 10% to 15%. So those are the investment action that we have taken for our portfolio in the year of 2021. And next, I will actually share with you all in terms of the portfolio performance for our portfolio. So you can see over here, you can see the performance for year of 2021. Our aggressive portfolio actually delivered a returns of 7.1%. Balanced portfolio delivered returns of 3%. Like I mentioned just now, last year wasn't really a very good year for the fixed income markets, specifically the local bond fund, or especially the Asian high yield segment, which had hit about 15 to 20% down in the year of 2021. So those segments has actually dragged down the overall performance for our conservative portfolio. And if you look at for the Islamic portfolio for the year of 2021, for our Islamic portfolio, because we don't have exposure to the foreign bond fund, especially the Asian high yield. So the performance is rather resilient within the conservative space, about 1.3% positive returns for our conservative investor and about 6.5% returns for the aggressive investor. So over a longer horizon, you also can see that, for our conventional portfolio, on a 3-year annualized basis, the performance ranging from 5% annualized return to 14.3% annualized return for our aggressive portfolio. Whereas for Islamic portfolio, which we started slightly later, we started our Islamic portfolio in the year of 2019. So we look at a 2-year annualized return perspective, the annualized return over the past 2 years ranging from 4.8% for the conservative portfolio and also 12.4% for the aggressive portfolio. So those are the performance of our conventional and also Islamic portfolio over the past couple of years. And if I move on to the last part of today's sharing, which is also one of the most important part to share with everyone in terms of the overall investment outlook for 2022, and also how do we position our portfolio moving forward for the upcoming years. So before I start to share a little bit more on our portfolio strategy and also the investment outlook, I think one particular question that a lot of investors tend to ask at this point in time is really about the rising interest rate environment. I think for some of you who are having some financial background, probably from a theoretical perspective, we always say that on the rising interest rate environment, it wasn't a very good situation, or it wasn't a very good environment for the equity market. So traditionally, people always tends to think that if interest rate continue to go up on a rising interest rate environment, it will actually affect the overall equity performance. So if we take some of the historical performance as an example, you can see clearly between the period of 2003 to 2007, there is a period where we see rising interest rate environment, and also between 2015 all the way to 2018, 2019, we also see a rising interest rate environment. So if we try to zoom into a specific or a particular period, you will actually see that there will be volatility within the equity market, especially when time that there's some announcement from the central banks. There will be some volatility here and there if you try to zoom into a particular period. But let's zoom out from this chart, and you can see clearly that between that period from 2003 to 2006, or even 2015 to 2018, 2019, although interest rate is on a rising trend, if you look at the equity prices, it's also on a rising trend. The most important factors or the most important element to us is really when we analyze the equity market, it's more important to look at the fundamental itself and also valuation of the market itself. Try to think about one thing. I think there's two perspectives that we really need to consider when we think about the rising interest rate environment where we hit the equity market. First of all, it's really when you think about during a rising interest rate environment, it means that when investors want to invest into a particular asset class, or if they want to invest into a particular investment product, the opportunity costs tend to be higher and higher during the rising interest rate environment. And under such scenario, right, investors will actually start to look for asset class with a higher growth potential. So that's why if you look at it, sectors, equities or companies with a higher growth opportunity, those are the segments that investors tend to chase after. That's one perspective. The other perspective is that try to think about it during the beginning, at the early stage of a rising interest rate cycle, investors actually tend to stay away from fixed income assets, and we will see more capital being moved into the equity market. The key reason is because during the early stage of the rising interest rate cycle, we all know that the bond prices is actually negatively correlated with interest rate. And why should I actually lock in a much lower yield at this point in time? I will actually wait for 2 to 3 years later, wait until there is a peak of the interest rate, interest rate that being set on a global basis. Then only I consider to move my asset from all these high growth sector or high growth asset class into the safer fixed income assets. So these are the two perspectives that we think about it when we really concerned about the rising interest rate environment. So from our perspective, we don't think that rising interest rate environment could really hit the equity market badly. But one thing for sure is that do not expect a broad-based rally, a broad-based recovery within the equity market like what we have seen in the year of 2020. Because during an environment with a more tightening monetary policy, with lesser liquidity in the financial system, we don't expect a broad-based rally within the equity market. So we have to be more selective when it comes to picking some of the asset class, when it comes to picking some of the funds into our portfolio. And if I move on to the next slide, when it comes to our inter-asset allocations, for the year of 2022, we continue to like equity, and we expect equity to outperform fixed income asset in the year of 2022. So at this point in time, we are holding a 5% overweight in equity, and we're actually underweighting bond by 5%. There's a few reasons why we actually overweight equity and why we think that equity could outperform fixed income. The first thing is because of the rising vaccination rate globally. If you think about it, I mentioned just now, in the first and second quarter of last year, Asian and emerging market, they couldn't really benefit from the recovery. You know, some of these countries, some of these regions, they're still being hit by the second, third, or even fourth wave of COVID-19. So that's why at the current point, you know, we are seeing rising vaccination rate. We do think that, you know, a lot of these Asian and emerging market, they are standing at a much better position to capture the global recovery. Secondly, we also see a very strong recovery within the corporate earnings. If you look at the corporate earnings that have been released for the second and third quarter of last year, we continue to see earning upward revision. We continue to see earnings start to beat, earnings continue to beat expectation. So these are the strong factors that we think matters to a value investor. There's a lot of factors that we need to think. We need to really think about it. You know, things like, for example, like in the past we have trade war. Right now we have COVID-19. You know, we have the lockdown in China and so on. So these are some of the noises that we have been hearing in the markets. But for us, as a value investor, what is really more important is really on the fundamentals and also the valuation of the specific segment that we're investing in. Last but not least, on the rising interest rate environment that I mentioned just now, we do expect fixed income asset has a much lower chance to outperform. So that's why with these kind of factors, we do think that for the year of 2022, it could be another equity year. Last year itself, it was an equity year, and this year itself, we think that it could be another equity year. Within the fixed income asset, like I mentioned just now, although we see much lesser opportunity, but there is one space particularly that we like, which is the Asian high yield segment. I think if you all have been following the cases very closely, the Asian high yield space have been affected quite badly over the year, specifically because of the slowdown in the China property sector, and secondly, because of spillover effect from the Evergrande case. So overall, if you look at the Asian high yield segment, right now we actually, I mentioned just now, we're actually holding a 15% tactical exposure in Asian high yield. We're actually underweighting our position in Malaysia short duration and long duration bond fund. So we are actually putting about 50% of the total fixed income exposure into this Asian high yield. There are a few reasons why we like Asian high yield. First of all, I mentioned just now, if you look at the overall economic situation in Asian country, they're actually on the right track of recovery. And because of the overall economic recovery, moving forward, we could actually see a much lower default rate. And subsequently, from the monetary policy perspective, we do think that there is a lesser pressure for the Asian central banks to really tighten the monetary policy as aggressive as some of these developed markets. So on the monetary perspective, we think that the policy overall could be more supportive as compared to the developed market. And I mentioned just now, you know, and one of the key reasons that trigger or cause a sell-off, a significant sell-off within the Asian high yield space is because of the Evergrande case. And if you look at the overall Asian high yield segment, what we think is that the sell-off is more of a sentiment driven instead of a fundamental driven. Hence, if you look at the current point, we are seeing double-digit yield to maturity within the Asian high yield space. I think the yield to maturity at this point in time is about close to about 12%. Now, with double digit of yield to maturity, we really see very attractive opportunity within this segment. So within our portfolio, within our fixed income portfolio, we are actually holding a 15% of our tactical allocation into this Asian high yield segment. And if I move on to the equity portfolio, so these are our exposure towards the various equity market in our portfolio. Right now, just to sum it up, right now we're actually underweighting US and European equity. We underweight Malaysia. We only hold about 5% of our actual exposure in Malaysia. At this point in time, if you think about our technology exposure, way in early 2021, we are having about 10% exposure in global technology, which is the US technology space. So right now we have cut our exposure for global tech significantly. We cut by half, and right now it's only about 4.8%. Within the technology segment, the space that we really like is China technology. We are holding a 2.2% overweight in China tech, and in our portfolio, actual portfolio, we're actually having 7.2% of our exposure out of our total equity exposure in the China tech space. So I won't go into details on each of these markets or for our overweight and underweight position, but there are two markets and segments that I would like to highlight for today's session, for today's sharing. First one is China equity market as a whole. We do believe China equity market has likely bottom. And for the year of 2022, it could be a contrarian back for China equity market. If you think about China equity market in the past 1 year, because of the power shortages, because of the slowdown in property sector and also the regulatory crackdown, the growth slowdown in China has actually came to a level that we think the policy makers can no longer ignore. And this exactly happened over the past couple of weeks. We have been seeing PBOC, the China Central Bank, has started to cut their interest rate, has started to cut their RRR reserve requirement ratio. So this action have proved, if you think about it, this action that have been taken by the PBOC is totally opposite of what we have been seeing in the developed market. In US, we have been seeing Fed talking about raising the interest rate, but in China, they are cutting the interest rate, they are cutting the RRR to support the overall economic growth. So what we think is that right now we are actually seeing a more supportive monetary policy, but we think that moving forward, we will continue to see not only from the monetary policy perspective, but also from the fiscal policy perspective, we are going to see a more supportive policy to support the overall growth for China economy. And because of this, we do expect that moving few quarters down the road, we are going to see a positive or upward revision in China GDP and also in China earning estimate. So these are the key reasons why we think, in the year of 2022, it could be a year for China equity. And because of if you look at the current pricing, look at the current price level, we think that a lot of the negative news has already been priced in the equity markets. Another segment that I would like to highlight, which is also specific to China, but it's more specific, which is China digital economy, the China technology segment. I believe I mentioned just now, in the past 1 year, the China tech company like Alibaba and Tencent has been hit quite badly. This company from the peak levels, their prices have dropped more than 50-60%. But what we are seeing right now is that people, when we talk about China, when we talk about China tech, I think one of the key questions that a lot of the investors they tend to have is that investing into China, it seems to be like, policy risk at this point in time, it seems to be the biggest risk for China equity market. But try to think about it, take a step back and think about it. Over the past 5 years, 10 years, policy risk has been the key risk that we are taking when we want to invest, when we make the decision to invest into China. So this is not the first time that we are seeing policy risk when it comes to investing into China. But one thing for sure is that if you think about all this policy, all this new policy, new regulatory framework being put in place in China, it is actually meant for the future of China, meant to deliver a sustainable growth for the China economy and also for the respective sector. So we have been seeing more and more companies within the tech space, they have actually completed their ratification as required by the new regulatory framework. And a lot of these companies, they do acknowledge the fact that if they want to survive and they want to operate in China, they have to follow the new guidelines set in by all these policy makers. So that's why we think that what have been done in the past 6 months or 9 months is really for the benefit of the Chinese people, and also it is also to make sure that the technology sector in China as a whole, they will be able to register a more sustainable growth in the future. And don't forget one thing, 2022 is really a politically important year for China, because the CCP, the Chinese Communist Party, they are going to host their 20th National Party Congress in November, which this is going to determine whether or not presidency is going to continue another presidential term. So usually during such a politically important year, the Chinese policymaker, they tend to prefer social and economic stability. And if you also take a step back and think about it, why they would like to implement and put up so much of new guidelines to regulate the tech industry and also to regulate the property sector as a whole. Another perspective to think about it is that it could be also because the policymaker, they want to set a low base for the year of 2022, for the country to grow much stronger. And you think about it, after cleaning all this mess in 2021, we're actually having a lower base in 2022, and it's actually set a much stronger stage for China economy to grow much stronger this year itself. One very important thing is that apart from all those factors, sorry,
Jerry, it's moving to 4:30 right now.
Okay.
So you might need to speed up a bit.
Yep, I think this will be my last slide.
Okay.
Okay, thank you so much. Yeah, I think with this slide, I mentioned just now, apart from all those factors that I mentioned just now, from the fundamental perspective, what very important is that if you think about with all this regulatory crackdown for the year of 2022 and 2023, the China tech sectors as represented by iShares Hang Seng Tech ETF, they are still expected to register double-digit earning growth of about 15% and 20% for the year of 2022 and 2023. So by giving them a PE ratio, price to earnings of 30 times, we do expect upside potential of more than 80% for the China tech sector by the end of 2022. So those are the factors I mentioned why we actually like the China digital economy, the China technology sector. So to sum up my presentation for today's session, we like equity market this year for the year of 2022. We do think that equity market could outperform fixed income asset. And we are actually overweighting equity by 5% at this point in time for our portfolio. Within the fixed income segment, we see value within the Asian high yield. We're actually keeping 15% of our total fixed income exposure in Asian high yield while underweighting the Malaysia bond. Within the equity space, we like Asia Japan equities, particularly China and also China technology. So we expect this segment to record a very strong turnaround in the year of 2022. Yeah, so I think that sums up my presentation, my sharing for today's session. Let's see if we have any questions from the crowd, and we are happy to answer any questions.
Yes, Jerry, please move on to Q&A session right now. You have
okay, sure, no problem.
Yeah.
All right. Okay, so we have one question that asking about why don't the managed portfolio invest in ETF instead of just unit trust fund? Yeah, I think this is also something that in our pipeline, we're actually considering to include some of the ETF into the portfolio, but it won't happen so fast in the next few months time. But this is definitely in our pipeline, and moving forward, we are going to have some ETF in the portfolio. But of course, when it comes to ETF investment, I think maybe I need to clarify a little bit, because when we think about investment within unit trust and ETF, people will always think that it's better to invest into ETF because ETF, the cost is much lower. But we need to also think about which kind of sectorial exposure or which are the geographical allocation that we want to leverage on ETF, because not all markets, not all ETF are appropriate for different equity market. For example, if I want to invest into China equity, if I were to invest into Malaysia equity, I wouldn't be using ETF, because there is a higher chance of the unit trust fund to really outperform the ETF on this kind of an inefficient market. So that's why when it comes to considering whether or not to include ETF, we also have some of these factors to do consider. Yeah, so maybe we have another questions asking about equity goes up when interest rate goes up. Previous interest rate high, the equity did not go up as steeply as seen recently. Yeah, so I think we need to think about I think this is mainly referring to the steep rally in equity prices. I think this is mainly referring to the US equity markets, and you are right to say so, because US equity market is also one of the markets that we are currently underweighting. From the valuation perspective, US or US technology, the global tech space, we do think that the valuation is really at a stretch level. That's why we're actually cutting our exposure from this space. But if you take a step back and think about the rest of the region, like Asian, like China, or even emerging market, these are the markets that we don't really see a strong rally within the equity prices, and these are the region that we really see plenty of investment opportunity. So that's why there's a key reason why in our portfolio for this year itself, we are actually overweighting more towards the emerging market, Asian, particularly China equity. I think there's another question asking about with the reason close to 11% drop in NASDAQ, and also with limited funds, which would you choose to invest in between US tech stock, China A, and also China H share? Yeah, no doubt that NASDAQ over the past couple of weeks, it has dropped more than double digit. But from our perspective, from the valuation perspective, we still think that the valuation for NASDAQ for the US tech are still actually at a higher end compared to China A or even China technology sector. So at this point in time, our preference is actually still China markets, particularly China A and also China technology sector. These are the two segments that we really like at this point in time. Despite that, if you're really comparing the recent performance, the recent 2 weeks performance, it seems to be China A and also China tech has actually outperformed the Nasdaq. But we don't just look at valuation over a short period of time, because if you really look at the whole picture as a whole for Nasdaq, for the US tech, and also for China or even China tech, we really see quite good opportunity within this China A and also China tech space as compared to the US tech.
All right, Jerry, the time is almost running up, so maybe you might
take
two
one more
questions.
Yeah, okay. When you say you expect equities to outperform fixed income, do you mean that equity will have higher return? Yes, yeah, there's a key there's a key understanding of this outperform means. The meaning of outperform means that we do expect equity to deliver a higher return compared to the fixed income asset in the year of 2022. Yeah.